Good evening, everybody, and thank you very much. I'm afraid we don't have any wacky or fantastic videos. It's just a fairly boring set of slides, which starts off with the normal disclosure that everybody is basically providing. Like par equity, we in fact have decided to put up very quickly for everybody our investment since 2013. It's not as impressive as par equity, which I was blown away by, so congratulations to them. But it is actually a good start in this fledgling industry. As you can see, we have 23 million in EIS, 7 million in SEIS, 2 million in BPR, and we have 2 cash exits to date. I think the fact that cash exits is actually quite important because it means we've returned money at 1.47, I think it is, 1.45 on average to our investors, which is obviously good news. Our whole period is slightly less than you'd expect. It's 4 years rounded down actually. And yes, we have had losses on the SEIS portfolio and the EIS portfolio. It's all part of learning how this industry has evolved, and in fact it's taken us to where we're going now, which is to look at pipeline origination. I think it's quite important. Like many of my colleagues here, we don't camp out at Google or any of the other campuses. We don't scour the exhibitions for deal flow. We don't pay intermediaries for deal flow. We do look at opportunities which we understand, but we don't look at ones which either we don't understand or, again, like others in the room, our experts don't understand. It's quite simple for us. If we can't understand it, then chances are the investing public won't understand it either. Finally, we have a network of professional expertise and professionals who bring to us about 50 deals a year we look at. And I think the last bullet point is actually our USP, which is we structure deals, we create things, we look for solutions before the companies actually move into investment so that they can actually see where we're going and how we're all going to get out of it. And I think that's, again, is really quite important. And as using that as an example, we're going to use a case study called Scratch Meals. So using this sort of the strapline anatomy of a deal, here's our original on the left-hand side, what we look for in an initial review. I think it's about 7 or 8 steps. Some of that will look familiar to others. It probably isn't rocket science, but we do religiously follow it. And in Scratch, we were able to satisfy ourselves that this was a company looking for EIS money. It was actually looking for debt funding, but it wasn't going to get it. It was looking for remortgaging, which it wasn't going to get. And it was looking for trade finance, which there weren't sufficient personal guarantees to get. So equity in this particular thing was the right way of looking at it. The company had grown to 6 million, turnover all through large FMGs, Ocado, Waitrose, Sainsbury's, the like, etc. Scratch's aim was one we could understand. Where do they want to get to? They want to be the leading brand in the space. This is the space of food kits. I think we've already seen Rickshaw, which is obviously doing very well, along with others. But to us, the reason we like this was they were in Waitrose, where their green curry I'd seriously recommend to everybody, especially if you go home and this evening and everything's looking a bit sort of tired and cold. They basically have good founders. They both have experience in the sector, so that ticked a big box for us. They basically provided us with their own competition analysis, which our consumer brand expert looked at, took apart, put it back together again, gave us a few more ideas about where in fact the problems might lie and where in fact we need to make sure we have sufficient cash. Obviously, we then looked through the working capital to make sure that the business would be able to produce enough to not only sustain its current position, but to allow it to grow. And in particular, what we were seeking to do in year 1 was to grow the business from a £6 million turnover to 9 million. Finally, they do have ambitious and proven management, and this is a good opportunity to scale in this market. The second process we go through is basically VIT, is what we call it, which is valuation, investment size, and heads of terms. If we can't agree these, then there's no point in going forward. So we try to do this quite quickly, and this then allows us to create a heads of terms agreement, which predefines all and populates all the investment and shareholders agreements. I think the key thing here is in the bottom one, which is basically, well, the second 2 actually. that having agreed a valuation which was based on revenue, and again revenue was linking back to PBT, we were able to look at how much cash was actually required, and what we were after was enough to allow for there being a delay in manufacturing production, but at the same time the cash had to be invested. There's no point in just sitting in someone's bank account. And then finally, terms. Scratch noted and accepted that we require comfort over governance, formal reporting, normal sort of stuff, including reserved matters. However, this still took 6 weeks to agree, and this is an interesting example. If someone agrees too quickly, the chances are your terms are wrong. Again, if they take too long, the chances are your terms are wrong. So consequently, we were able to agree this. It took 6 weeks, and included in that agreement were the fees for the transaction and fund management. I'm sure some people here will say there are no fees. There are fees. There are always fees. It's just a matter of how they're paid, whether it's by the company, as in the case with Deepridge, and ourselves most of the time, whether they're paid by the investor. There's an argument to say that where the investor pays for it, you get a better quality of company. Where the company pays for it, maybe not. We, like everybody else, we try to get 100% relief wherever possible. The final thing was we wanted the investment completed by the end of the tax year. Surprise, surprise. Gate 3 is basically due diligence and investment agreements. I'm not going to go through everything in here. All I will say is that we have, like most others here, I guess, a template set of agreements which we used. Lawyers always try to take out the bits they don't like. We try to make sure they stay in. But our guiding principle here is, are we protecting the investors? That's the key thing. Are we putting any blocks on the company growing? Have we got access and have we got reserved matters? So they're the key elements for us. Commercial review took place at Scratch's offices in Grimsby. Like everybody else, we go and kick tyres, because if you don't go and kick a tyre, you don't actually know what's there. And because the business was already trading, we were able to make sure that what they said to us in the initial DD was in fact supplemented and met. The tax affairs were quite simple to review because they were up to date. We then basically looked at the commercial review and everything was really okay. We weren't too worried about it. It passed the review, which not only provided insights for us, but also provided insights for them. Oh, hit the wrong button, sorry. Okay, part 4 is the approval. Because we'd already agreed the deal, provided everything in the deal was in shape and in good order, we were able to then move on to the actual investment. And maintaining this approach very quickly, we have a very good pipeline for Q1 29 for both SEIS and EIS investment. And allegedly, we're very nice people, because that's not Section 21 verified. Thank you very much.